Greetings and welcome to another CrashWatch video. This is the S&P 500 5-year chart, and for those of you who have been watching my CrashWatch videos since the beginning, at this market top I called it and said that we would see a gradual decline, which we did see, and then I said that eventually the ultimate bottom will be at an S&P 500 level of around 3,000. That script was unfolding very well until about 6 months ago, because money printing resumed in Japan and China, and now money printing has resumed in the US as well, as you can see from this video up here in the upper right hand corner, which was the previous video on this channel. So money printing has already resumed because internals were weakening in the global economy. But the US Federal Reserve seems to think that money printing versus deprinting is entirely decoupled from the Fed funds rate, and nothing could be further from the truth. So the US Federal Reserve is printing money again, and therefore world net money printing is positive, returning the S&P 500 into strength rather than the weakness that was occurring before. But the Fed funds rate is still rising based on past inflation that has already occurred, and inflation was already falling. Also evident from that video I linked 30 seconds prior. And all these PhD economists in combination do not see the interconnection between all of these things. They will be forced to lower the Fed funds rate very quickly once the market begins to have some trouble due to the bifurcation of a Fed funds rate being very high while money printing has resumed. So this is the S&P 500, and again I was saying this 3,000 level should be hit based on this longer term trend. 3,000 is not low. It's pretty high relative to the levels of 2018 and 19, which were not a weak economy at all. That was actually a very strong economy. So 3,000 should still be on the cards, except for the fact that money printing is going on. Now let's look at two other indicators that are adding pressure to the stock market and the economy despite money printing, because of that very nonsensical hike in the Fed funds rate that the US Federal Reserve is doing, even though there is no inflation that warrants that type of a hike. So we go to the yield curve next. This is one manifestation of the yield curve, specifically the two most important data points in the yield curve, which is the 10-year US Treasury rate, which is an important indicator of inflation, minus the Fed funds rate, which is the one that is controlled by the Federal Reserve in an attempt to clamp down inflation. And they somehow always react far too late when raising that and lowering that. And when this yield curve is inverted, the economy is in trouble, and when the yield curve is very inverted, then the trouble is piling on much faster. So the way to look at it is, when this number is already at zero, that's a problem, because the Fed funds rate should not be as high as the 10-year yield. A strong economy requires these two numbers to be about 2 to 3% apart, and specifically 3% apart in a 0% Fed funds rate age, an age of technological deflation, as I describe elsewhere on this channel. But now the 10-year yield is about 3.7%, while the Fed funds rate is almost 5%. And that's why you have this yield curve that's at minus 1.28%. If it were that inverted for just a few weeks, nothing would happen. But the area enclosed below zero is a measurement of the cumulative pressure on the economy from this inverted yield curve, as well as dislocations between the US dollar and other currencies in the world. That very severe 2008-2009 recession had an inverted yield curve for a while, but still not as deeply inverted as we have today, and the area accumulated today is already beginning to match up to this area over here from the prior recession. Smaller recessions have had far less of a problem. We had this negative yield curve situation begin to happen in 2019, and the Federal Reserve was forced to reverse their rate hikes, and this is before COVID. This is still 2019. So this was small. It would have been a recession had the Federal Reserve not acted quickly, but they did in the nick of time. Now this is already big, yet they're still raising rates, even though what little inflation there is not because of the Federal Reserve. It's because of oil prices being higher due to the Russia-Ukraine situation and the Biden administration obstructing U.S. fracking, thereby further making the price of oil higher. It's not even the fault of the Federal Reserve, yet they are raising the Fed funds rate because they think that killing millions of jobs is the way to reduce inflation. That's like saying the way to lose weight fast is to start draining out your blood. But again, these PhD economists are hyper-theoretical, and they usually get it wrong because they only interact with people who've read all the same textbooks as them, which happen to be textbooks that are 70 to 100 years old. So as this area gets larger, the pressure on the stock market becomes higher and higher. A very similar measurement that we're going to look at, which is somewhat related to the yield curve, but only towards the longer maturities, is the mortgage rate. And I've spoken about that as well in prior CrashWatch videos, so let's go there. This is the US 30-year fixed rate mortgage rate. And as you can see, things were stable and fine when this was about 4%. Then because the Federal Reserve had to print money, yes, but they printed money in a way that involved buying mortgages and treasuries, that caused a distortion in this market, making mortgage rates unusually low. And since most people cannot process a two-variable equation, everyone started to buy houses when rates were low, not realizing that rates being low simultaneously causes the home price to rise, so the payment ends up being the same, except you are in a situation where you're far more likely to end up with negative equity when rates rise again, versus when you buy a house when rates are high, then you may gain positive equity from the fall in interest rates. And that's a two-variable equation that's too complicated for most people, but if you want to make money in home equity, that's what you have to be very acutely aware of. Buying when rates are high and then rates lowering after that is when you make your home equity gains. So trapping a lot of people into buying a house at this inflated price and then raising rates so fast through the Fed funds rate also pushes up the mortgage rate, not high enough because we saw that inverted yield curve. So the mortgage rate is not pushed up as high as the Fed funds rate, but it's still pushed up enough to cause this problem because, as you can see, this is too drastic of a rise. Therefore, the same size of mortgage has a payment that's more than 2.5 times what it was at the low not too long ago, 2021. And then home prices fall, of course, because the interest rates are high, and therefore all the people who bought in this period are in negative equity, which is very bearish for the economy because then there's no new home purchases, people feel poorer, then they lose their jobs while their house is in negative equity. A big debt spiral starts to begin. Then the Federal Reserve has to print more again as well. So this also can exert a lot of pressure on the S&P 500. So in closing, we saw that there's a bullish factor now supporting the S&P 500, which is the resumption of money printing, but a bearish factor that is the inverted yield curve and the high mortgage rates because the Fed funds rate has been hiked up and the type of money printing being done is also not the diffuse type, as I often talk about. That's why these mortgage rates are still staying high, and the area enclosed over here, as I've spoken about in other videos on this channel, is a measurement of cumulative pressure on the housing market triggering a housing crash. Unless this goes down pretty soon, we are going to have a housing bust again. I hope you found this video to be informative, and if you like this type of content, I encourage you to subscribe to this channel. Thanks for watching.